Good morning, everyone. Welcome and thank you for joining our webinar today. This is Jyoti here from My Time Equity. In today's webinar, along with Sudhir Pai, we have Anup Nayak from My Time Equity. Before we start the webinar, I would like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, My Time Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, let me take you through the disclosure slide that our attorneys mandate that we show prior to every webinar. If you have any questions during the presentation, please feel free to type them in the Q&A box and we will have them at the end. If you need Sudhir's help, please write to wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Thank you very much, Jyoti. You can hear me, right?
Yeah, I can.
Okay, wonderful. Okay, very good morning to all the listeners and thank you for joining, on a Saturday morning. The market has been going through a rough ride. At the end of the week on Friday, we saw a little bit of positive sentiment. The market turned a little green, the S&P. So we have titled this particular webinar as "Is March the Turning Point for 2025?" Which means are we going to see further downside, or are we going to see the correction getting completed, and are we going to see an upside from here on? So that's a difficult question to answer. So we have produced a lot of data here, which I will take you guys through. So we hit the 200-day moving average on the S&P 500 on the daily chart, which means the trend has turned a little negative. The positive trend, once it touches that 200-day moving average, that's when we have to be cautious. And why has this happened? This has happened because of all the uncertainty and the noise that we are hearing in the market. You know, the noise is related to all the tariff noise that is coming out because Trump keeps changing his mind all the time. There is a heavy tariff going to be levied on China, Canada, uh, and uh, Mexico, and reciprocal agreements to be signed with other countries. So this can increase the cost of inputs for the US economy, which means the inflation can remain high, and the earnings of all the companies in S&P 500 can see a little bit of lower earnings, because of which the market is taking that into account and making the corrections to the price. And we have seen all-time highs, over the last 2 years. We have made significant gains. So there has to be some money to be taken off the table. So those who are in significant profits, I think, are selling. And there is a little bit of trading going on, because when the markets are so volatile, it's like the trader's paradise. A lot of shorting, a lot of trading, and a lot of profit taking is what causes this kind of a correction in the market. So overall, S&P slipped about 3.1%, touching 5770, and Nasdaq was 3.5% decline, and Bitcoin, was up and down. The summit took place yesterday in the White House, so that was good. That government is recognizing Bitcoin to be the mainstream, to be the internet of 2025 and ahead. Web3 is going to be, and blockchain is going to be the next wave. So with all that, there has been positive sentiment on crypto, but there is correction taking place with respect to the prices. Those who bought into crypto over the last 3-4 months might have seen significant correction because of all the speculative news that comes out on a daily basis. And generally, crypto is a very volatile asset. Particularly Bitcoin is a super volatile asset. The volatility of Bitcoin is around 60, while the volatility of S&P 500 is around 20. So that will tell you, how much of ups and downs you can see in Bitcoin particularly. So going to the next slide, we will cover some data for you here as to why we are still positive about the market. Why are we not in cash? Why are we still in equities? And what gives us that confidence? So this slide shows you, the first quarter performance of presidential years, since 1950. So what did S&P do since 1950, the year after, presidential election? So if you see the first quarter one, year one, because we are in the quarter one, year one after Trump got elected to the White House. If you see, it has been only 0.01% up, and that happened 55% of the time since 1950s. But the good part is, if you see quarter two, the returns are much higher, and quarter four the returns are even higher. And so we look at this data as a positive news for us to be staying put in the market. It's not only this, overall the market, the environment is pretty good, right? Job losses have started happening only at the government level, but the private sector is still fine. The job report that came on Friday was pretty good. It was not at all bad as we expected. Some amount of higher terminations taking place in January, uh, but that did not happen. So the numbers were positive on the employment numbers. And coming to the inflation and Fed interest rate cuts, if those things happen, and then the biggest thing is the tax cuts. If the tax cuts get approved, I think we are going to see a similar blue candle, in quarter two of 2025. So looking at these numbers, the past data since 1950, which is excellent data, for us to be positive about the equity markets. Next slide, Jyoti. Okay, so this shows us, how weak February played out for rest of the months in a particular year since 1950. So the previous slide was considering the presidential first year. Now this is what this tells you is, since February, if February month has been negative, then how will March, April, May, June, July, August, September, October will be, rest of the year will be, and this data goes all the way back to 1950 till 2024. So if you look at since 1950, March is a positive month. Past 20 years, if you take into consideration, because since the internet came into existence, the data is behaves very differently. So we take past 20 years, then we take past 10 years, and then we take post election year. So if you look at all the numbers for the month of March, they are all up, they're not down. If you look at February, you can see that black bar, going down and towards around 1.5%. But if you look at March, it's positive. If you look at April, it's positive. May, it's a positive. June is where there is a little bit of downside in the post-election year, but July is a good month, and then November is an excellent month. So this is based on the past performance of S&P 500 over multiple scenarios. Again, past performance doesn't mean that the present will be exactly matching that, but this is a piece of data which we should rely on before we take any decisions on our portfolio for the current month. Next slide, Jyoti. Okay, this is the third data point for you guys. The rule of 10 best days. What this basically means is, if you are in the market, you better be in the market over a long period and not get in and out all the time. Because if you try to time the market, what happens is, when the market falls, it falls pretty fast. And when the market goes up, there are few days when the shoot up is so great that you, if you miss that, then you may end up getting the best returns which the index would otherwise give. So if you look at the data since 1928, so we have two sections, since 1928 and since 2014, the S&P's return was 8%. But if you remove the 10 best days of the year, then your return goes down to negative 13. So the positive number becomes negative. So very important, So if you add up those two, 18 plus 13, that's what the loss you would have made just because, you are trying to time the market. And since 2015, the S&P's return has been 12%. And if you remove the 10 best days, that reduces it by to minus 10. So, it's very important to be long in the market, not try to time the market, not to panic when there is a slight correction, and not to get excited when there is a huge breakout. So it is better to be patient and mature when your money is in the equity markets. One thing to keep in mind is, companies in S&P 500 are very strong companies. These are not those companies which will like go down just because there is one big news in the market. The market will not turn negative and all of the sudden, go to the cost basis that you might have bought it for or go to zero. And one of the reasons why we enter into ETFs, we have ETFs portfolio, which I'll show you the performance of that so far, is because ETFs can never go to zero. Individual companies can go to zero, but ETFs will never go to zero. So you are always protected because of the diversification that you get through an ETF. Very important point, and that is why we have multiple models in the as ETF models as well as a lot of models on the individual stock side. Next slide, Jyoti. The fourth data point, S&P 500's annual return versus annual return minus 10 best days. This is exactly what that the previous slide was a summary, but this gives you more breakdown. If you look at this, focus on 2023 and 24, we got a 24% and 23% return. Now, if you remove the 10 best days of the year, your return falls significantly down, right? So it's very important to stay long in the market. That is what this slide is also reiterating. Next slide, Jyoti. Okay, so the impact of tariff that S&P 500 may have. So the all the news that we are seeing about tariff on Mexico, Canada, Europe, China, and all the other countries, the largest imports that US has is from the first three countries that are listed here, which is Mexico, Canada, and China. So the imports are high and exports are low. So even if these countries try to put more tariff on the US's exports, it's not going to impact US that much. But the tariff that US is levying on these countries is certainly going to increase the cost of material to the US. Like for example, if there is a tariff on steel or wood or lumber, all of that will make the construction of a home more expensive. If there is tariff on basic stuff, day-to-day expenses go up. So, inflation will continue to remain high because the end of the day, the end consumer who uses the product will be the one paying for, all these taxes and tariffs. So, if you look at this chart, it basically says that a 25% tariff on Mexico can have an impact of around 7.5% on S&P 500's earning per share. So, the recent news that we have seen or we have heard, is going to impact the S&P 500 by around 6%. And S&P 500 is down by around 7% from its all-time high. And we are believers that when such correction happens, the correction can go all the way down to 11%. So if we are at 7% down, there may be a further correction of another 5%, depending on the news and the catalysts that we get to experience over the next few months. Next slide, Jyoti. Yeah, so this is the earning growth of large cap, small cap, and mid cap. As you guys know, there are three types of capitalizations of stock in the equity markets: large cap stock, small cap stock, and mid cap stock. So if you look at the earning per share projections of these companies, the small cap stocks are supposed to do very, very well from for the year 25 and ahead. That is because small cap stock has been very low and there is value in investing in them, because over the last 2 years, if you see the blue bar, it's down 12% and 14%. The earning per share of small cap, which means the amount of money that small cap stocks will make over years is only going up because it has remained down. And the projection of these smaller companies, when you look at the CEO's guidance and the companies filing with the SEC and things like that, it has been reported that the earnings of small companies and mid cap companies are going to do much better than the large cap companies. So it is very important to understand which asset class or which part of the market capitalization should your money go into, right? If you put money in S&P 500, they are all large cap companies. So you may not get the best return in 2025 or 2026 if you are purely in large cap, because last 2 years we saw a major upside on the magnificent seven companies, which includes companies like Google, Tesla, Nvidia, Apple, Microsoft, Netflix, Amazon. These 7, 8 companies did extremely well over the last 2 years. That is because when inflation is high and the rate of interest is high, the comfort is in putting in the best growing companies, right? And those are technology companies. So those companies are valued at a very high valuation right now. And that is where the money is going to find its place in value. And that is in small and mid caps and value based large cap, which is the other 490 companies that you have in S&P 500. And also international stocks such as markets such as China. India has seen a significant drawdown over the last few months. So India also seems to be picking up now. We had a breakout on Thursday. So there are also other countries, emerging countries, Europe, Germany, and other emerging countries like Indonesia, Saudi Arabia. So there are multiple markets that we see. When we invest our clients' money, we are not trying to get you the highest return, but we are trying to see how the money flows, and we also flow along with that, with the hope that we will be able to beat the S&P 500. That's our goal, but we will never try to do that. To give you an example, on Friday, we uh, we our models went into cash for about 5%, just to be on the conservative side, to buy that 5% worth stocks when if there is a further decline. And then we took a hedging position of another 5%. So we are a bit cautious on 10% of the portfolio, but 90% of the portfolio is still in large, small, mid, international, and metals and crypto. So we are only being cautious with 10% of our money. Next slide, Jyoti. Okay, so what else is happening, on next week? Next week we will see the Jolt's jobs opening report for Jan. These are very important numbers. And then the big one is core CPI, that measures the inflation. So if inflation continues to be hot, meaning, if it is going to be more than 0.4% or 0.3%, whatever is the forecast for February, then we are going to experience some noise in the equity markets, and then, it can go any direction. If the CPI continues to go up, the market may assume that interest rates are not coming down because inflation is high, and that may send some more money into large caps and pull some money out of small caps, because small caps are very interest rate sensitive, and market overall is also very interest rate sensitive. So which direction will the market go is very hard to say, but we get some clue from these numbers that come out on a weekly basis. Then there is also the PPI numbers that are coming out on March 13th, on Thursday. So next week is filled up with a lot of news, and that means more volatility in the market, and you will see green to red and red to green continuously throughout the day and throughout the week. Next slide, Jyoti. Okay, here is a quick glance at our models. S&P was down by 3%, for the week. And our models, if you see on the right hand side, China model was 6% up, and the custom models that we have were down by similar percentages, 2.74 and 2.97, with interactive brokers and the Schwab account down by about 4%. But if you look at the year-to-date numbers, we are very, very close to S&P, and the two portfolios for the year-to-date have been red, have been very green, the contrarian portfolio and China. And on the international, on the ETF side, which you can look on the left-hand side, metals and crypto have been very green because gold really was good. Cryptos, Bitcoin did well, Ethereum did well in the first 4 days. And the international markets are doing extremely well. We are, as I said, we are long on China, India, Poland, and Europe. So there are multiple countries in that model, and that model we are very bullish on because money will find its own place, when US is going through a volatile time. Next slide, Jyoti. Okay, coming to the structured notes, we have launched this new structured note uh, for uh, for our clients. This is closing on April 4th. As you can see, the names are all solid names: Meta, Microsoft, and Amazon. And each one of these companies have seen a significant correction, except Meta, which is 8% up. But Microsoft and Amazon are down significantly, and Nvidia, Tesla is also down significantly. So the idea here of these structured note, whenever we bring these notes, it may be a good idea to keep investing a little bit of money in every note. That way you can dollar cost average it, right? If you had invested in a structured note in Microsoft or Amazon or Meta, like 3 months back, your price point was higher, whereas now your price point is lower. Let's say we bring another note in 3 weeks from now, and market continues to correct by another 5-6%, then you will be dollar cost averaging. So don't put all your money in one note. Put them across multiple notes, and we are working very hard to bring you multiple notes, in a month, and multiple nodes with individual stocks, with ETFs, with S&P futures index. So you have multiple options that is coming to you from My Time Equity. So don't rush to make an investment. Think through, talk to us if you have questions, because sometimes if you talk to us, maybe you'll get a bigger perspective than just thinking of putting 30K here, 50K here, there. That's your decision. But if you want us to tell you how to allocate your money across various asset classes, not only stocks, but also private credits. We have private credit fund with Blackstone that gives about 9% fixed return. And then we have with TPG, which is about 13%, with Jeffries, which is about 13%. So there are income-based funds and then growth-based funds, income-based structured notes, growth-based structured notes. So this one is a growth-based structured note. The way this works is if all of these three stocks are flat or positive at the end of year one, you make 30% return. It does not have to go up significantly in order to get 30%. Even if it is flat from the price of April 4th, you get 30% return. Or let's say if it is down at the end of year one, and then it goes to end of year three, and at end of year three you get 3x of the actual return of one of these three stocks, which is the lowest stock. So let's say Microsoft is the lowest performing stock in 3 years, then you get 3 times the actual return of Microsoft. So if you are in Microsoft yourself, invested in the market, all you get is 1x, and you have no downside protection. Here in this note, you have 50% downside protection. That means as long as the stock of these three, price of these three stocks does not go below 50%, your money is safe and secure. But if it hits below 50%, that's when you get only the differential back. Let's say Microsoft is down 60%, then you would end up getting only 40% back, because that is how this contract is written. This contract is issued to us by BNP, one of the strong banks in the top list of banks. And this note closes on April 4th. That means if you want to get in this note, you will have to write to us ASAP. And we have a upper limit on this note. I don't think we can issue more than 500K all put together. So you may want to reach out to us ASAP and communicate with us and let us know, how much you want to put in this note. And we don't have a lot of time, right? And the amount is only 500K for us cumulatively to invest in this. Next slide, Jyoti. So we had talked about this note last week because this note was open then, and this is closing on March 12th. So not a lot of time. This is on Palantir, Nvidia, MicroStrategy, and Tesla. Now all of these names are super volatile names, and if you look at Tesla, it's already down around 29% from its all-time high. And MicroStrategy is a company run by Michael Saylor, which is following the Bitcoin strategy. They are hoarding a lot of Bitcoin, and Bitcoin and MicroStrategy has a positive correlation. And Nvidia, we all know, has been really getting hit because of multiple news coming out from China, such as DeepSeek and their other AI model that they launched last week. And Palantir rose very, very high and now seeing a little bit of correction. So, if you look at this note and ask yourself or ask me the question that, hey, why are we investing in these volatile names? Because when the market is doing well, everybody wants to get into that, right? And when the market is falling, everybody is scared of investing in it. So, whereas we have to do the reverse, we have to always invest when the market is down, we have to get out when the market is high. But most of the people do the reverse. So, this note we are launching here, and we are clearly telling our investors that these are volatile stocks, and you may not be able to get payment of this in a particular month. But if you look at the rate of return, it's 30.1%. The income that you get paid is almost 2.5% per month. This is certainly much better than a bank CD or giving money to some small uh, you know uh, uh, company taking all the risk for getting 10-12%. Here you are trusting four best companies in the US, which certainly has certain challenges going on with Tesla and certain challenges going on with Palantir and Nvidia because of the way we see things happening with AI and electric vehicles and things like that. But this is a 3-year note, and we have a feature called memory included in this, meaning if any one particular month, if these four stocks, any one of them goes below 50% from today's price, right? This note is closing on March 12th. So from the March 12th price, if you see these stocks falling below 50%, that's when you don't get paid that month's interest. And since we have added the memory feature, if the stocks come back, and cuts back the losses, then you will get for the previous months also. So we have tried to package it in such a way where the risks are kind of covered, but nobody can tell exactly how the future is. So I cannot tell you how the future is. All I can do is bring a note to you which is giving 2.5% per month or 30% per year, and it's a 3-year note with a 3-month call option, which means the bank can return the money in 3 months if you are getting paid 2.5% per month for all the 3 months. And there is a memory feature in case any one or all of the stocks go below 50%. So we have tried to cover our bases as much as possible, but still, let me tell you, this is a very high risk and a very high reward type of a note. This is certainly not for a lot of money, but if you believe in these four companies and if you want to take the advantage of 2.5% per month, then certainly this is a place where you can put some of your money in. Next slide, Jyoti. Okay, this note also we presented last week. This closes on March 14th. It has three stocks: AMD, Palantir, and Micron. Again, all the three companies are solid companies, and the returns are very good, 1.8%. If you see, you don't have Tesla in this, you don't have MicroStrategy in this, super volatile stocks, and that's what brings the return down, you know, from 30 to 22.5%. Even this has the memory feature, and this note is issued by Barclays. Next slide, Jyoti. Okay, here is one of the more stable ones where the returns are extremely good. You may also get the actual returns of this particular index. This index reflects S&P 500, but it has a little higher volatility. S&P 500 has a 20% volatility, which means the when the market goes down, goes up, the ups and downs are like around 20%. Whereas this index, which is S&P futures index, is at 35% volatility with a 6% dividend decrement index, which means 6% of the dividends that are generated goes back in it, which increases the yield. We presented this note last week as well. In this note, what happens, you have a protection of 50%, means if the index goes down, you are protected to 50%. All of our structured notes, we usually have a 50 to sometimes 40%, but most of our index notes have a 50% downside protection, meaning till it's hit 50%, you are actually not losing anything. It's only below 50 is where you end up losing the first loss is yours. That is what happens in a barrier. And we have recorded a lot of videos and we have put it on YouTube and uh, in few social media platforms, Facebook and all. So you may want to join our social media handles and listen to those videos which I have recorded last week. Clearly explains what a structured note is, what a barrier is, what a buffer is. So gives you more knowledge. Knowledge is power, and then you can make a decision. Our job is to bring you all these notes based on our knowledge which you have gathered over last multiple years, and then figuring out what is right for you, and then asking us questions is what you will have to do, and then decide where to invest your money. This note is a very good one. The returns on it is 25% or the actual returns, and every year it doubles up. So first 12 months, the return is 25% or the actual return, and second 24 it becomes 50, then it becomes 75. So you see 25 keeps getting added every year. So if it is called, then you get that, and then we'll have to reinvest that money back in something else. But otherwise, you get the greater of 25% or the actual returns at the end of each year. So a little complicated, but at the same time, much safer than some of the individual stock names when it comes to, market crashing or market going down significantly. If market is continuing to be like what it is, what it has been and what it is right now, correction of 5 to 10% is normal in the equity markets. So because everything that goes up has to come down a little bit, right? We all try to buy and sell. So when somebody sells, then obviously, the prices go down. Not everybody is buying every day. Some people are selling, and that's what is going on from last 2 weeks, 3 weeks. Yeah. Next slide. Yeah, this table shows the results or the performance of that this particular index, the S&P 500 futures 35% volatility index. This is an index issued by JP Morgan. You can Google it and you will find it. If you type the code SPX FD356, you will get to see this performance. Just focus on the last two columns. S&P 500, for example, in 2025, the last line was 2.7% for January. This has not been updated for February or so far in March. So it's up to January end. So S&P was positive 2.7, whereas this index was positive 3.69. If you look at 2024, it was 2% more than S&P. If you look at 2023, it was almost 9% more than S&P. If you look at 2022, when S&P was down by 19%, this was down by 42%. But we have a 50% downside protection in our note. This performance works, applies to you if you are directly investing in this index. But if you are investing in our note, as you know, first 50% is protected. So if you see the red areas, in 2008, this index went down by about 54%, while S&P was down by 38%. So it really does very well when S&P is up, does very well on the downside also, when S&P is down. So that is where we have the 55% protection. We have 25% per year if it is flat or positive or the actual returns. So I think this note is one of the best notes that we have seen on an index connected to S&P. So, if you are one of those conservative people, but also is a little aggressive, based on the knowledge that you gain, then this note is very good for you. And you should look at this very closely. And you can also dollar cost average in this note. We will be bringing this note every month, because this is a standard index. We'll keep bringing this every month or every quarter. You can keep investing a little bit of money every month and build a portfolio, a laddered portfolio of this index. So your returns uh, go on a monthly basis. As they mature, you'll keep getting money on a monthly basis as well. Next slide. Okay, I think that brings the webinar to an end. Those were the slides I wanted to present. Give you the understanding that we are not like other financial advisors who just put money in the market and sleep. We watch the market very closely. We try to be a little active, not very active, because we don't want to miss the 10 best days. But we will be hedging ourselves anywhere between 5 to 20% when the markets are bearish, so that we can buy the dip. And we have these structured notes which are non-correlated as much as direct equities are, because of the protection and because of the flat or positive rule that we have. And because they're created for 3 years, we are comfortable that over 3 years, anything that goes down will come back up. Whatever has gone up too much will come back down. And these notes are very liquid. If you want to get out of it any day, you can get out of it. It is not that like a real estate investment where once you put money in, you'll have to wait for 5, 6 years. This is get in, get out any time of the year, any time of the month. Then we have these private credit notes, which is between 8 and 13% fixed return, which you keep getting every month as long as private credit industry is thriving. And that's what is going on from last 2 years. The private credit markets are doing very well. And these are all big brand names like Blackstone, KKR, Apollo, Ares, TPG, Jeffries. These are some of the companies that we work with. And we also have other opportunities which we can talk if you are interested. We can do financial planning for you and your family and tell you, where you should be investing and how and when. And we usually charge about $2,500 for financial planning. But if the asset value is more than $1 million, we can do it for no cost, with an understanding that your idea is to your plan is to work with us on getting your money managed and become a long-term client of ours. So if you have any questions, feel free to type them in the chat box. We'll try to answer as many questions as we can in the next 10 minutes. And if you want to join our WhatsApp group, scan the QR code there on the slide or send us an email to wealth@mytimeequity.com, and we'll add you to the WhatsApp group. The WhatsApp group, it's a one-way WhatsApp group. We post messages. We only share information about what is going on in the equity markets, two updates every day, the opening stock market and the closing stock market. And we post our videos and we post our structured notes, launches, any new information which I think I should write, I post it there. So you will not be spammed in that WhatsApp group. You will not be having multiple people writing. It's just me and my team. So I think it's a very good group to be part of. So join that group so you get the latest information. And yeah, let us know if there is anything else we can do. Jyoti, we can take questions now.
Sure. Thank you, Sudhir.
Yeah.
The first question is, while numbers and charts provide a statistical perspective, now we see some structural changes like tariff, inflation. What can we manage meaningfully interpret from this?
So, well, the current administration is trying to achieve two things, right? One is to bring down the deficits that we as a country have. There is almost $47 trillion of deficit. How do you plug that? Or does Donald Trump also keep kicking the can down to the next president, and make America poor? So that's a problem that he's trying to solve. And second is the trade deficit, with all these countries, while all the countries are are charging US a lot of tariff. For example, if you want to buy a Mercedes Benz in India, you would pay almost 3 times more than what you would pay here. So Trump's point is, if you are charging us tariff, we will charge you tariff. It's okay for our people to pay more, and we will figure out our problem. And that is being done by lowering tax rates. If companies are going to pay 15% tax, it's all good for our American companies. So more companies will come to the US. And now he has brought up this idea of Trump Gold Card, wherein a company invests $5 million or an individual invests $5 million, they get citizenship. So there are a lot of structural changes that are happening, and structural changes are painful. And the pain will remain for some time, but long term it is positive. So, that's where we kind of hedge a little bit. We don't go into cash fully. As I mentioned, our portfolios went into around 5% cash and 5% hedge strategy, which means we are not totally in equities. There is something which can go against equities. So if markets are down, that will be positive. So, vice versa. So while we understand the long-term impact of what is happening, I think the short-term impact will be painful. It is all till you see a catalyst such as tax cuts, or Doge kind of going slow, or Elon Musk kind of taking it slow, or tariff just becomes a negotiation tool and not really a big tariff on every country. When that happens, you will see a very, very big green candle on those days, right? So we have to watch, we have to be careful, and then we have to take actions. But certainly volatile times.
Yeah, thanks, Sudhir. Jyoti had to step out. I'm taking the questions.
Sure.
So the next one was thanks much, Sudhir, for sharing good information. The question is on structured notes like MMA and APM before March 14th. AMD, Micron, and Palantir stock prices went down in the past 2 to 3 weeks. Will it be a good opportunity to buy these notes at cheaper cost price?
Well, we don't know whether we didn't know whether that we are going to see this 5-7% correction in the index, which means 2 to 3 times more in the individual stocks. You never know when these kind of things happen, right? Nobody knows when Trump is going to do something, or something is happening in the world, with respect to wars and geopolitical tensions. Nobody knows that. Either you sit in cash and you wait for the right time to invest, or you kind of invest a little every now and then and kind of dollar cost average it. Or if you're already in the market, be there, looking at all this knowledge and not take any action, because most of the money that we invest in the market is not for tomorrow, right? It's for future. For tomorrow's money, you keep it in the bank account for as emergency cash. If you are in the job, you keep earning, that is what goes in your day-to-day expense. So one has to take a 360-degree holistic view when they are thinking about investing their money in stocks or equities, or ETFs, right? So the answer to the question is, it is cheaper today, certainly, compared to what it used to be a month ago. So, if you're not in it, maybe, it's a good time to invest in it. But how much money to invest, that's a call that you will have to make, and we can help you if we get on a call, getting to know, all your net worth, assets, liabilities, income, expense, and a financial plan. We can guide you as to what is the right amount of money to be invested in this APM note.
Yeah, thanks, Sudhir. Since you have done lots of talking, I'll take a couple of questions and try to answer that.
Yeah.
The next is, can you explain SPX FD356 snowball using an example? So the way it works, as I always tell, let us assume that you invest 100K, and on that particular day, which is March 21st, the value of SPX FD356 is $10. So on March 21st, 2026, which is exactly 1 year after the notice launched, if the value is either $10, which is the price of the stock, that is on the 21st of March 2025, or if it is a $10, 1 cent, or $11 or whatever it is, as long as it is flat or positive, for the 100K invested, you get 25,000 gains. So in your bank account, around that time, you will see 125,000 credited. But what happens for some good reason if SPX FD356 has grown up, the $10 stock is now $13, which means there is a 30% appreciation of the stock. Then in this particular note, and this is the beauty of the note that we all like, is that you get 30% instead of 25%. So there is no cap. So then 130,000 get credited, in a year's time. But for some reason, if the value of the stock is not 10, but instead it is 9 or 8 or 7, basically the SPX FD356 is down in 1 year's time, then it jumps to the second year. Now in the second year, which is March 21st, 2027, if the value is again 10 or above, then this time you get 50%. So for 100K invested, you get 50,000 back. Like I mentioned earlier, if for some good reason, if the value of the stock is appreciated by, let us say, 70%, then you get 170,000 back. So this goes on all the way up to fifth year. At the end of the fifth year, you either get 100, if the value of the this particular stock is more than 10 or more, then you get a minimum of 125%. So for 100K invested, you get 125,000 back. So your bank will get credited for 225K. Or if the value is more than 125K, you get that. Okay. So these are all good scenarios. But what if the value is still down? It is at $9 or 8 or 7 or 6. Till the value of the stock is not hitting $5, which is 50% down, you still get your principal back. So your 100K will be credited at the end of the fifth year. But if the value is, let us say, $4, which is a depreciation of 60%, then you only get 40,000. That is a risk that you have got, right? So this is an explanation that we wanted to give. I hope that clarifies. If you have any questions, feel free to reach out to us. There is a phone number that we have listed down. We can mention that. Now, the other question that I can also answer is, do you work with 401k IRA portfolios? Answer is yes. We work with, as we mentioned in our flyers, we work with both retirement and non-retirement accounts. It can be 401k, it can be IRA. Likewise, the non-retirement funds, if you want to have a joint individual brokerage, we also work on that. Right? So these are the two questions that I thought I could answer. Now coming back to you, Sudhir, what are those 10 best days? Are they same every year?
Oh, no, if they were same every year, then it would have been so easy, right? Life would have been so easy. No, it's not the same every year, and we don't know which day of the year that is. So that's why we have to be in the market. You can't get in and get out. You have to be in the market. So yeah. So I think we are out of time, Anup. I have to run. If you want to
Okay.
take some more questions, you can, but
Yeah.
I need to jump.
Okay, sure. Thanks.
Thank you very
Sudhir.
much, folks.
Okay.
Okay.
The last two questions is, are you considering bringing up any notes which are based on international market, India being a prime example? Yeah, so we work with the banks here, and right now we are limited to the one that is being offered by the US. But in future, if there are any changes, we will definitely keep you posted. That is why we are requesting you to subscribe to WhatsApp and email messages. That way you get to know what is happening up to date. And please share the link for recording so I can understand the structured notes. Yes, by end of the day today, all the clients who have either registered or attended this webinar, they will be getting the the list of the recording through email, and then we'll also post it in the WhatsApp probably tomorrow. But in the event that if anyone has not reached out to, not got the recording, do send us an email or call us, and then we will send the recordings. I think these were the questions that we had. I hope it was informational. Jyoti, if you're still around, then if you're back, then we can close this call.
Thank you, Anup. Thank you everyone for joining our webinar, and we really appreciate for your time. And definitely we'll meet next week. Thank you and have a great weekend. Bye-bye.
Jyoti.
Thank you, Anup.
Yeah.